Hey, welcome everyone to this morning's webinar all about buying commercial property in self-managed super funds. My name's Ben Walker, if you don't know who I am, and I'm joined by Colin and Lachlan, who is co-presenting with me. And I'll do a bit of an intro on each of us in a moment. But firstly, thank you, Colin, for joining.
Thanks for having me, Benny.
Awesome. All righty. And in terms of a broader introduction to Inspire as an accounting firm, this is a photo of our team, and we're pretty proud. We've saved our clients over $22 million in tax accounting. That was of sort of around June-ish 2022, that number. And if you're not currently working with us, but you would like to talk more about maybe some topics that we discuss in the webinar, or if you're exploring a change of scenery when it comes to your accountant, then feel free to book in for a strategy call. One of the team will post the link in the chat box in a moment. Actually, Tay's already done that. Thank you. But yeah, there's an opportunity just to have a free chat, no obligation, with one of our team. Also, I might mention some upcoming events we've got. This one will be interesting. So in a couple of weeks' time, Thursday, the 27th of October, we will be debriefing from the first Labor federal budget since they were voted in. And we'll be packing apart what it means for small business owners, high net worth investors, and SMSF. So they're kind of the lens we look through when it comes to the budget debrief. So if you are interested in what that means for you, then please, there's a QR code on the screen. Otherwise, again, Tay has been awesome and popped the link to register for that in the chat box. That'll be interesting. And what I've heard about the budget is this one might not rock the boat too much. Labor's just got voted in. They probably don't want to piss too many people off at once. But the news I've heard is that it's probably not this one. It'll be the one in early next year that may have some interesting changes when it comes to, especially potentially refundable franking credits, and a few other bits and pieces that Labor has signalled over the last decade or so. Yeah, that'll be interesting. I also want to share, I published my book about a month ago now, Wealth for Life. So that is now available for purchase on our website, or the link has actually been sent through again by Tay. And if you do want a copy of that, you can buy it with free shipping if you use the code SMSF for being live on this webinar with us. And we will send you a copy of that one. And in that book, I detail the 9 steps for building wealth for your family and your life. And where some of those topics we talk about is actually what we're here on the webinar today to talk about, which is SMSFs. There's heaps of information in there on that. Talking about property, what to keep an eye out for, also related here, and debt, which Colin has stepped in for to share on how we fund property, commercial property. So yeah, it's got definitely some topics that are relevant for today. In terms of a quick intro to me, so yeah, as I said, my name's Ben Walker. I started Inspire when I was 23 years old. I'm an award-winning chartered accountant with 13 years accounting experience and author of the book Wealth for Life. And in terms of my, why am I sharing this stuff today? I've been I love SMSFs. I've been a member since in an SMSF since 2011. I've looked after hundreds of SMSFs. It's a tongue twister. Hundreds of SMSFs over my career, including auditing many funds when I started at KPMG. Around about 60% of Inspire's SMSFs hold some sort of property. So with our clients we look after, it's in the 60%. So most of our SMSFs have property in some form, whether it's resi or commercial or developments, or all sorts of different options there. I'm an advisor on many purchases and restructures, and around 28% of our clients have an SMSF. So we love them. We need to be quite well versed in them, and so I love sharing about them. And I want to introduce you to Colin Lachlan as well. So Colin is the director and mortgage broker at Arch Brokerage. He's also award-nominated mortgage broker, and a member of the Mortgage and Finance Association of Australia. You're in the top something of mortgage brokers. in last year?
Yeah, we won a Best Newcomer award last year it was, and then we were also a finalist for Sole Operator. We just had our most recent sort of national awards, and we were actually nominated. We had a new broker come on board, so it's fairly new. So there's two of us for probably about a month of the year, and we're actually nominated for. We were a finalist for brokerage of the year for less than 5 brokers, which is pretty special. So
how good. There you go. And Colin's background extends for, is it over 10 years with Westpac?
Yeah, worked for a few different corporations, but sort of started out in 2008. So that's been the best part of 14 years in finance and mortgage broking, which has helped me in good stead. So
yep, fantastic. Explains the awards. Very good. Alrighty. Well, in terms of the topics we're going to cover, we'll cover the SMSF's ins and outs. It's really important when we're looking at buying in SMSFs that we understand the pros and cons and the things to be wary of there. Then Colin's going to share in detail around some of the lending options, including giving some idea of like how much you need in super to buy at certain price points. So yeah, I've really loved Colin's information. I've obviously seen it before now, but looking forward to him sharing that. And then also some case studies that we've seen over the years with our clients. So that's the sort of simple format for today. So I might kick off with the first bit here, which is SMSF's ins and outs. Now you can buy commercial property outside of super. That's normal. You can also buy it inside of super. That's just as normal. So I guess what we need to work out for the client is what's the best outcome for them. Now, in terms of outside of super, there's slightly less complex lending. I wouldn't say it's like completely simple or hugely different to lending inside of super. It's just slightly different. But it turns out I feel like commercial property is easier to borrow money than resi. Would you say, Colin?
Yeah, and it's funny that, not to go too far into it, but it's funny that you say that, because buying something in self-managed super fund from a commercial aspect can often give you some better terms than if you're buying it outside. You might have a stricter loan term if you're buying it outside of super in comparison to inside. So which is an interesting one.
There you go. Didn't know that. And then I guess from a tax perspective, outside of super is absolutely a higher tax outcome. There's no doubt there. Inside of super, you get taxed at 15% or 0%, depending if you're in accumulation mode in your fund or pension mode in your fund. So yeah, we do love a 0% tax rate at Inspire. Business and personal income can be used to service the loan. So that's kind of different for outside. And then inside, they actually Colin will share what they look at for servicing with SMSFs, but it's actually pretty decent. You can use other security. So if you've got equity in other properties, maybe in your own home or other properties, you can use that equity for security outside of super, but you cannot if you're buying it inside of super. So yeah, sometimes clients, if they have one property in their SMSF, they might want to sort of pay down that loan as quick as possible and then draw on the equity to go again. Currently, unless this has changed recently, Colin, we can't access the equity in a property to then in an SMSF held property to then go and use that as a deposit on the other one. Yeah. So that can catch people out. In terms of like what's the same about both, your business can own or occupy a commercial property held inside of super or outside of super. There's no difference there. When it comes to residential property, like an investment property, you can't, or your family members cannot live in a property that's owned by your SMSF. That breaches the old sole purpose test and the rules around that. And you can see the LVRs go to 80% in or outside of super. So that's pretty cool. All righty. So the other thing to mention with the inside of super is you cannot borrow for construction costs unless it's off the plan. So we've seen some clients buying off the plan commercial premises. It's not constructed yet, but because it's one contract or one single asset, that's the thing that matters from an SMSF perspective. But if you're looking to do, let's say, like a I'm going to make it simpler, but like a house and a land package where you've got a contract with the land developer and a contract with the builder, that cannot happen in an SMSF. That just breaches the rules. So that's a bit of an overview on that one. Now, in terms of borrowing in super, this is like really weird. This is technical, sort of legally accounting stuff, but I think it's worth sharing because it, at least you kind of expect to see these words if you go and pursue this. But an SMSF cannot borrow to buy property in its own right. So the actual SMSF itself cannot do that. The SMSF needs what we call a bear trust. There's like custodian trust. There's a few different names for it, but it sits in between the property and the SMSF, and the bear trust actually borrows the money, and the title is actually sitting in the bear trust until the loan is paid in full. So it sits in the middle as like a shadow purchasing entity. You can borrow the money from a bank, but you can also borrow money from your own other entities. So we've helped clients, and I'll share the case studies later, but we, client had a bit of cash in a bucket company. They actually lent that money to their SMSF to buy a property under this bear trust arrangement. So, there's multiple ways we can fund property in super, but it can be a bank or it'd be yourself as the bank, one of your other entities. Alrighty. Other SMSF options are buying outright. So you could pay cash completely for a property in your SMSF, have no loan attached. You could also buy outright with no loan, where you've got part of the property held inside and part of the property held outside of your SMSF. So we've seen that done and helped clients with it. So they might, let's say the property costs 300 grand, 200 grand is secured, or is paid for from the SMSF, and 2/3 of the title is in the SMSF's name, 1/3 is outside. But the rules for that structure is that there's no mortgage on that property. You can't have any security on it. And then the other one we've seen is buying it in what we call a suit, or a superannuation unrelated investment trust. So you've got to be unrelated to the other partner in this. So you've got to have 2 or more business partners, and neither of them can own, or no one can own more than 50% or control 50% of that entity. So again, there's tons of different ways to make this happen. And yeah, well, we kind of say where there's a will, where there's a way with this stuff. So tell us what outcome you want, and we can guide you on the structure or the options for the structures. And also worth noting with SMSFs, your super fund's investment strategy must be updated to include the ability to purchase this. So generally, like no investment can be made unless it's specified or allowed in the investment strategy of the fund. But the members and trustees can update the investment strategy. So it's not locked in when you set up the fund. You can update it as you go, but it's important that this thing must be done from a regulation and audit perspective. And the accountant can prepare based on your instructions. So if you say, hey, I want to buy a property, but I want this much in cash, this much in shares, we can document that and send that out for you. Cool. Well, that's a bit on the SMSF side of things. Hey, I'm going to pass over to Colin now, but I did do a bit of a call out for Q&A earlier. So if you've got questions that are popping up, please pop them in the chat box or the Q&A box. I'm going to be monitoring that. We also will have time at the end for Q&A. But yeah, again, happy to take the questions as we go, because sometimes it's great to address stuff when it's, we're in the moment, we're on the topic. But alrighty, well, I'm going to hand over to Colin now to run us through commercial lending.
Awesome. Thanks, Ben. I think probably one of the things whenever I came out and started to be a mortgage broker, one of the things that I was really passionate about was the education space. So, I mean, for us, this is something that's really becoming really prevalent at the moment, is self-made super fund lending. I know that we've got a lot of clients that are sort of going through the process of, either buying their first commercial property or, buying multiple properties. So, we recently just did a first home buyers seminar, and really it's just the drive of like wanting to educate people so they've got information at their fingertips, so they're in a better position to, ultimately make some decisions, getting them into a better financial position. So, what we might kick off with is a bit of an overview of sort of what are the type of things that are funded generally. And there's a few options there. It's things from shops, factories, warehouses, offices, and as sort of Ben touched on before, sometimes it might be for investment purposes, or sometimes it might be for people looking to buy a space for their business to move into. So that's a bit of an overview of sort of the things that are generally funded. Now, in terms of the assessment of what the bank's looking for from an income point of view, I actually love the commercial self-managed super fund space. It's a bit of a tongue twister in itself, just because it's very simplified as to how we look at the borrowing capacity. So one of the beauties of it is they'll take in most cases, they'll take 100% of the market rent, excluding the GST and outgoings. They'll also take into account your super contributions from the last 2 years. So one of the good things that a few of the lenders do is they'll actually consider if you're putting in extra funds for that current financial year. So I know that there's sometimes rules around contributions and then how much you can put in for that year and previous years if they haven't necessarily been used up. So it can be a really good strategy, and I won't get too much into it. I'm sure Ben can speak to it a little bit further, but it can be a really good strategy to be dumping money into the fund that then boosts what you're able to borrow. So that's something that can be considered along the way. So it's not always like a one size fits all. It can be sometimes not manipulated, that's probably the wrong word, but it can just be viewed in a way where we can get it to a stage where you can get a capacity where it gets you something that you're looking for. The other things that they will consider on sort of a case-by-case basis is the remaining assets and funds and the potential returns that they've got coming back into the fund. From a really simple point of view, and why it's got the bit down the bottom around combined net incomes, needs to be a 1.25 times cover. Essentially, let's say that you had a repayment of $50,000 a year from a loan point of view. Essentially, it just needs to cover 1.25 times that with the income. So if we looked at 50 grand, as long as there's about 62.5 in market rent, super contributions, or potential remaining returns, then that would be sufficient to tick off and be able to get the loan. There's no sort of extra buffers or worries or anything else that you need to consider when looking at it. So it's just a very simplified version of is there enough income coming in? What's the outgo? And is there a positive part there? So that's a simple view on how the borrowing capacity is calculated from the bank's point of view.
Yeah, fantastic. And I think the other thing with the contributions, I feel, yes, contributions are one thing for servicing, but it also might help if someone's a bit short on the deposit they need to buy at a certain price point, then the contributions could be used for the deposit and also servicing. That's my understanding.
Yeah. Absolutely.
Awesome. Great.
Okay.
All righty. Here we go.
All right, a little bit of a table. I find this great because it's real numbers to work with. Now we've fluctuated a couple of purchase prices there, everywhere from sort of 500 up to about 2.5 mil. Mm-hmm. The LVR, now that can change dependent on what you're buying. So, ultimately, this is to give you an overview of, I guess the highest point that we can go up to, but it does sort of change on a case-by-case basis. But more times than not, we can go to 80% on buying something in self-managed super fund, which is surprising because I know probably a few years ago, and we get this feedback a lot that, we thought it was 50% or 60%. There's a few lenders out there that are doing the self-managed super fund lending, and the ones that are doing it really well. Yeah. That's what I always say to people. Now, if we look at... Yeah, sorry.
Just on the LVRs, what sort of security or property type do you see them lend less than 80%?
It really depends. So a couple of factors that I guess it comes down to, where is the property located, and then what type of property that they're buying. So it's really just a matter, it's a quick answer that we can get, but it's really on a case-by-case basis where we get the information, we check it with the lenders that we've got available on panel, and then they provide us with what the LVR would be on that. I know that we just to probably talk about, I guess, one that was a little bit restricted. We had a client that was buying an old bank. Actually, it used to be an old bank, and they were moving a medical practice into the particular office, and because it wasn't quite equipped for, I guess, for it to be a sort of that medical office from the get-go, that's where the bank turned around and said, well, wait a minute, there's some risks here because it used to be a bank. It's not necessarily set up for that. Yes, you can go to them with a fit out and those types of things, but that's where we sort of saw a reduced LVR from that standpoint. So it's really just the main thing I'd say to people, anyone that's on there today that's interested in looking at it, feel free to reach out, because if you've got something in mind, you've got something that you want us to look at, just let us know, and then we can let you know sort of if there's going to be any restrictions or what the overall LVR is going to be on the property. So
awesome.
Now, I'm going to go into costs a little bit more shortly, but this is just sort of a summary. So if you're buying something for 500,000, in this instance, at 80%, you'd be borrowing 400 grand from the bank. There is about 30 grand worth of costs, which encompasses, stamp duty, which is like the government cost side of things, and also bank fees. And then also any third-party costs, things like solicitors. So overall, if you're buying something for 500,000, you need about 130 grand as your self-managed super fund balance, which is pretty much going to go all towards buying the property. Now, all lenders are slightly different on this, but if I pick out the good ones, there's no real liquidity test at the end of it, meaning that, I'm not saying that you want to drain your self-managed super fund down to zero, but there's no sort of 10% rule or anything like that. It's more so, have you got enough money there to do it? Yes, you probably want a little bit reserved for own peace of mind, but as a simplified view, if we turned around and we wanted to do that with a bank today, and you had 130 grand, you could buy something for 500,000. I won't drain down and go through all of them, but you sort of get an understanding of, the different loan amounts at 80% on all those purchase prices, the varying costs, and then what the balance looks like at each of those. So I'm sure, Benny, we would be able to send this out after perfect. So we'll send it out, and just a little bit of information for you to take away, and just gives you something tangible to work towards if you've got something in mind. But feel free to reach out once again, and we can absolutely have a look into it for you. All right.
Karen, I just saw your question there, but I will that's kind of a tax sort of related one, so we might address that towards the end. All right. Don't
anyone fall off their seats with the interest rates. Self-managed super fund lending always attracts a higher interest rate than what's at the market. Obviously, as everyone I'm sure has heard, over the last 6 months or so, there's been some rate rises. If you haven't, then maybe you've had the news switched off, which isn't necessarily a bad thing. But this gives you a little bit of an indication on what things look like. Once again, we've just used those purchase prices of 500, 1 mil, 1.5, 2 mil, 2.5. So your loan amounts are obviously at the top. Now, the key thing is the beauty of self-managed super fund lending, once again, which I guess sometimes people have a myth about, is that sometimes the lending can be shorter than normal, but you can actually do a 30-year loan term. Awesome. Which is great. You can also do interest only if you want to. So, which I'm sort of going to go into shortly on the next slide. But you do have those options available. You can go up to 5 years interest only with self-managed super fund lending, and then it reverts to P&I repayments. So, this I've just based solely on P&I. If you want some other numbers run, once again, feel free to reach out to us. But this gives you a bit of an indication on what it looks like. This includes sort of any monthly fees that you might come up against with the lenders that you go with. So it's just a good indication on what a repayment would be on that type of loan. Okay, and with the interest rates, are they variable? They are. Yep. So they vary. There isn't any. For commercial, I don't think that there's any current ones that are doing any fixed options through an interest rate wise. One thing that you're going to see shortly is this is obviously based on 80%. The more deposit you have, the more that you're putting into the property, it's very much like the lending in the market right now for residential as well. The more deposit you have, the less risk it poses to the bank, meaning that they're going to give you more preferential rates. So you see that, between 80 and 40%, that's obviously quite a large jump whenever it comes to a, self-managed super fund balance that you're putting in, but it does drop it down by 1%, which is a pretty big drop. So, and then just with interest only, there is a slight increase on those generally from bank to bank. So that's just a rough note, but 0.15 on top of those current rates is if you were going to take it as an interest only loan rather than principal and interest.
That's pretty decent. Very good.
Yeah.
And just, I guess, for anyone watching the recording or watching live, these rates that Colin's mentioning are as of we're doing this on the 14th of October 22.
Yeah.
After, and they're variable rates, then obviously it may not be the same. But what I find interesting about it is that's actually like pretty, like it's like in terms of the cash flow requirement for the business, it's not too crazy at all. Even this is P&I repayments.
And I think I was just going to say, Benny, and just talking back to the servicing side of things, and I think this is probably a big thing, is like, think about what you're paying rent right now, wherever you might be. If you're going to be moving in for owner occupied use, because the amount of time that we see this compared to what they're paying rent, there's really not that much variance. Now, what the bank will do is, if your business is going to go in and rent that property, or rent it from the self-managed super fund, they will add back the rent that you're currently paying and use that towards servicing as well. So, it's ultimately just, I guess, having a look at those numbers and see where that sits for your business if you're looking to move into it.
Yeah, fantastic. Alrighty. And hey, just one more thing with the loan structures. Sorry, I'll just go back a slide for this one here. But do the SMSF lenders offer offset accounts?
No offsets. No.
Right. So we need to be sort of careful with our long-term strategy with our SMSF, whether we're going to, what we're going to do with the excess cash that comes in from rent or contributions. Remembering what I said earlier about some mistakes that clients might make is to just pay down the debt on their SMSF, on their property held in there, expecting to draw down on the equity again later. But unfortunately, that cannot happen. So we need to make sure we know that in advance. And once it's paid off, it's paid off. We can't go and get it back without a sale. Which may not be ideal. Alrighty. The fee. Geez,
yes.
$2 million loan.
Yeah. I mean, and so they were factored into those costs that I had on that table. So, these do vary between lenders. 1%, sometimes it can be 1.25, sometimes it can be 1.5 of the loan amount. So the costs can get up there quite quickly, but this is a bit of an indication on the cost that a bank would charge when going through the process of funding a self-managed super fund purchase. The main one that can sort of vary in particular there, I would say, is that valuation cost. It all comes down to what you're buying. And at the end of the day, they're quoting on the valuation that they do based on what the property is. So, if you're maybe buying a small office, that might not be that's obviously not going to be as big a job as someone maybe buying a massive shed. So it's just more information that they need to obtain whenever they go through the process of valuing it. But what we do in all instances is we always get a quote, and sometimes we can get a secondary quote as well. So that's a bit of an understanding around the upfront fees that a bank would charge.
Yeah, okay. Do the banks negotiate on that establishment fee at all for the bigger properties, or?
I haven't personally seen it, to be honest. It's pretty sort of what you see is what you get. Like I sort of said, it does vary. Sometimes they go up to as high as 1.5. So it can be quite costly. But we can always ask the question whenever we're going through the process. So
there you go. Cool. All right. Well, what about we talk about the actual process.
Yeah, of course. So I think that the benefit really, and this applies to all things in finance. The more prepared you can be, just the easier the process it can make it. So if you're looking to buy something in self-managed super, what I would say is come and get a pre-approval. Buying commercial property in general is, for anyone that hasn't done it, that's sort of on the call today, it's a lot different in comparison to if you're buying a residential property, in terms of, and probably the main point is that valuation. Generally, to get what we call a long form valuation, which needs to be done with a commercial property, that can take anywhere between 2, 3, 4 weeks. So it's a much longer process. They'll go out and actually value the property, but there's a lot of research that they need to put in to actually then provide the valuation back to the bank. So from that standpoint, it just allows us to get everything moving a little bit quicker, and it just makes it a less stressful purchase for you. So the more prepared we can be, the better. Now I'll let you talk about too, Benny, but just jumping into the I guess the finance and the settlement. At minimum, you usually want a 30-day finance clause, and that just feeds into ultimately that valuation time frame. Sometimes we may look to reduce it. It depends on how prepared that we are. And then 60-day settlement is generally, they're the two main clauses and timeframes that you'd have. So that's a bit of an indication on the process itself, but the more prepared you can be, the easier it makes the process for you.
And I know that especially through COVID, the resi banks were just flogged, and it might have taken them 4, 5, 6 weeks, some of them, to pick up a file and have a look at it. With SMSF lending, is it pretty quick, especially
it's been a lot quicker, actually. I know that we actually, just to give you a little bit of a case study, we submitted one at the start of this week.
Yep. And
they've already picked it up. Yeah. So, whereas you're right, during that COVID period where I think all the banks were struggling with turnaround times, you're probably looking at maybe a few weeks before your application got picked up. So I think the good thing is we can move a little bit quicker at the moment, which I guess once again takes the stress off. Mind you, I'm not saying like pre-approval and that process of doing it that way, this is the sort of the perfect way to do it. But that doesn't necessarily stop you coming to me when you've got a signed contract and starting that process. We also will make that work if that happens to come up. So.
Yep. But with pre-approval, you don't need an SMSF set up to get pre-approval, do you?
No. Yeah. So you're able to essentially, I guess, provide some information around how it's, I guess, going to look. Essentially, we can get it pre-approved, and then you can go through the process of getting the bear trust set up. It's obviously critical when signing a contract, that you've got that information at hand, but before that we can get it pre-approved on the basis that there will be one set up.
Yep, great. And again, for pre-approval, you don't necessarily need a property, you just need the kind of key figures, let's say 80% LVR, rough budget. Great. So really, if anyone's sort of listening and they're sort of sussing out whether this is even possible, they could do it without going through the steps of that property selection and SMSF setup.
Yeah, and I think even just to get an understanding of where you sit, we don't need, we certainly will never put an application in and close our eyes and hope for the best. At that starting phase, we're going to do some due diligence around, okay, well, how do things look like? Tell us what you've got in contributions over the last couple of years, and then show us, are you renting at the moment? Are you looking to move into a similar property? How much rent would you expect that it would be from a market point of view? So those sort of critical things that we know will allow us to do some research and look into what you can and can't do.
Yeah, fantastic.
Yeah.
Awesome. Well, I guess that's great news. And just point two, the actual setting up of the SMSF and Bear Trust, so they can be set up at the same time. To set up the Bear Trust, we do need the address of the property, though. So if you don't know that, that's something that we do need for that step. But what I sort of recommend to clients is the setup process can take 1 to 2 months for your existing super funds to action your request to roll your current money over into your SMSF. And that's the bit we can't control, is how quickly that your current super processes documents. So I've seen it before where, if there's a spelling mistake, one letter missing out of the address or something like that, they might send it back and cancel the form and you start again. Or I've also seen another one, mail out checks that never got there. Cancel them, reissue them. So you just can't be sure how quickly that can happen. Sometimes it takes a couple of weeks, and from literally pulling the trigger on an SMSF to your current super ending up in your SMSF. So I would recommend leaving at least 1, but more so 2 months to be comfortable with that. And that's kind of your if we think of what Colin said about the settlement time, that's a 60-day settlement, ideally for that finance process and getting that sorted. We don't want to be pushing the envelope, with the rollovers from your existing super into your SMSF. I wouldn't love doing that mid finance application or that sort of thing. But again, if you've got a property or you're actively searching, then it may actually be a great thing to just get it set up, ready to go. Alrighty, and I think that covers Jason's question of how long. Oh no, sorry, this hasn't. This is another thing again. So, Colin, this used to be a thing a few years ago that you needed 2 sets of financials for the SMSF before the bank would sort of have a look at the lending. How long does I think we've kind of answered here, but a bank doesn't require an SMSF set up for any length of time.
No. It can be brand new. It can be brand new. So what they look at from a contribution point of view is you would just get your statements from your previous providers, and they essentially just want to look at what does 2 years look like, because they're just looking at the contribution side of things. So it's really just looking at what's the income from there, and then they essentially are just pulling that out as part of looking at the servicing model.
Beauty. How good. Alrighty. Sweet. Well, thank you, Colin.
My pleasure.
We will share Colin's details with people who have attended today, but if you do want to get in touch with him to run a scenario or the pre-approval process, or to talk about LVRs on a property address, like that sort of thing, he's happy to have a chat and walk you through that stuff. Thank you.
Yeah, absolutely. Thanks for having me. And, I like to think that we're a pretty open book in a sense. So just, if you've got any questions, you need any sort of assistance, or you want me to just run some simple numbers for you to see what you can and can't do, please feel free to reach out. We will be more than happy to help.
Awesome. Thank you. And I've just got some case studies to run through before we open it up for Q&A. So please keep in mind that we will have time for that. And if you do have questions, pop them in now. But here's some case studies. We had a client who was a vet from the bush. He held a property outside of super, so commercial property, roughly valued around 300 grand. He had an existing debt to a bank on that property of 150K. So his loan to value ratio was 50%. He moved that property into an SMSF. So he paid stamp duty on that. That's important if you own one outside of super. But he had enough money to pay the bank loan out. So his super fund had enough money to pay the debt outside of super out, and the transaction costs as well. So the stamp duty and that sort of thing. He lent the remaining money to his SMSF on vendor finance. So ballpark, he had 150 grand plus a little bit in SMSF that paid the bank loan out. And then the property was purchased with a 50% deposit in his SMSF from himself. Now there's still 50% left to pay. So the super fund needs to pay that from the SMSF to his own entity to pay the balance of that out. So this is getting complex without diagrams, but hopefully this is making sense. And so for this client, he's paying his 27.5 grand super contributions each year and his market rate rent into his SMSF as a tax deduction, and he takes it straight back out as a tax-free loan repayment, so that the SMSF owes him another 150 grand when he purchased it. So he's paying that back over a few years from rent and super contributions until the loan is paid back. So it's a pretty good outcome for the client. Again, it's kind of a complex one to sum up in a few dot points, but hopefully that made some sort of sense. Another case study is, this was actually quite a while ago, but a client doubled their super fund balance in a very quick amount of time. Pardon me. He had a commercial property owned outside of super, roughly valued at $1 million. Here the client was shifting into retirement, and he wanted to move more money and assets into super. He decided to move the property into super, so that triggers stamp duty and CGT outside. Keep that in mind. And then he borrowed the money from the bank. So his SMSF paid a deposit and the balance came from the bank. He wasn't an owner occupier, but he received rent for a few years and paid no tax on the profit there. Within 2 to 3 years, he received an offer to buy the property for 1.3 mil. Because he was retired, he paid no tax on the capital gain when he sold that. And yeah, compared with roughly 30% tax outside of super. So a great outcome for him. Cool. This is a more recent one. We had an IT business in Melbourne who was previously renting, but had grown significantly through COVID. The owner had an opportunity to buy a commercial property near his home, worth around 300 grand. And the settlement took most of the cash in his SMSF. So it's a young client. He didn't have a whole heap of cash in there, even though that's a small property purchase. Given the client's age, he didn't have a ton in there. The property needed a fit out, which was funded through the prepaid rent. So his business was an owner occupier in that property. And they basically prepaid a year's worth of rent to fund the fit out required. So just sort of maximizing the cash flow on that. And as a reminder, we cannot use borrowed funds to improve that. Colin gave an example of a client buying a bank a little while ago and then having to do a fit out to change it into like a medical center. That process cannot be done with borrowed funds. So they would have had to come up with the cash to do that, not borrowings. And then with this client, the fittings and furniture were paid for by the business itself to access the instant asset write-off. And then the client's now paying similar rent to what they were previously, but it's a bigger space and they're paying it to their own SMSF, building their own wealth. And our last case study is a client who's, it was a home office and they bought a premises down the road. And it's done quite well because this was I think in 2020-ish, before the market went nuts. So it was a service business in the building industry. So again, a business that grew through COVID. The client had an existing home office hitting its limit, and they had a baby on the way, so they didn't really want to have team members, showing up at home every day. The client purchased, it was roughly an 800K property at 75% LVR. It needed a reno, but that was funded from the SMSF from cash. The furniture paid for by the business, again, wanting to maximize that instant asset write-off. And they have a lovely shop front now to take through the next stages of growth. And they've got a second tenant, like a sublease arrangement, where there's another tenant helping them pay the mortgage on this one. So, and we can tick a lot of boxes from a wealth creation point of view, tax, growing the old super balance by making these moves, which have some great outcomes for clients.
That's a good point you just made there, Benny, as well, was, that's an option as well. If you're buying a premise with multiple zones where another business can actually sublease it, that can also be factored in as a part of servicing. So if you're looking to move into a potential office and then your plans is to sublease something, providing obviously whenever they do the valuation that they concur with what you're able to do with it, it is something that can be factored in.
Yeah, fantastic. That's that is handy at the time of finance. Cool. Awesome. All righty. Just to wrap up the formal bit of the webinar, feel free to give us a good old like and subscribe. On YouTube is where we actually post our webinar replays. So keep that in mind if you do want to sort of chase that recording. Otherwise, if you have registered for the webinar, we will send it out as a link in an email. Cool. And for those who joined a little bit later, if you do want to debrief with one of our accountants to talk about the strategy, then please book in for a strategy call with one of our team. And also we did, and we will share Colin's details as well if you do want to have a chat with him about the loan structuring. But that's the formal bit of the webinar come to an end. And yeah, we're here with a bit of Q&A time now. So we've only got one question so far. Thank you, Karen. Thanks, Stephen. So Karen's asked, putting profits into super to purchase a property, is it better than putting it in a bucket company to buy property because of the tax benefits? Now, Karen, it could be. So from a tax perspective, putting money into your SMSF, the ongoing tax outcome on that is going to be a lot less than a bucket company. But it really does come down to the client circumstances, what their goals are with the property, whether we sort of look to buy that in a trust or a bucket company. Usually properties we don't head to a bucket company sometimes, but not often, or we look at SMSF. The other reason why clients love buying commercial property in their SMSF or any property in SMSF is because it doesn't impact your outside of super borrowings. Actually, I might just double check that with Colin. When a client's buying property in SMSF, the borrowing capacity isn't soaked up outside of super, is it?
No, correct. Providing it's looking after itself. Absolutely.
Yeah. Yep. Cool. Okay. So yeah, again, there's just so many factors impact which structure to buy property in. Yeah, but options are trust, company, or SMSF broadly. But then there's options within each of those. Especially if you're buying it with a business partner or friend, family, all that sort of thing. That does make a difference. So yeah, sorry, that's not quite a simple answer, Karen, but hopefully that's helped. All righty. Well, that is all the questions that have come through, but I hope that has been informative. Thank you. Thanks, Karen. Actually, Stephen's asked a question, buying with a business partner, do we both need an SMSF or do we need to contribute evenly? I'm going to say that no is the answer to both of those questions. So you don't necessarily need an SMSF each. If one wants to buy in a trust, one wants to buy in super, and you don't need to contribute evenly. There's ways to do it in sort of whatever circumstances you've got there. So I'd probably just sort of run the scenario past Colin and or I. Colin will cover the financing thing because let's say you're not using SMSF, then this might fall outside of SMSF lending and under just general commercial lending. And then again, with structuring, there's requirements there if you're using SMSFs to make sure we're not breaking any rules there. So we kind of need to work hand in hand if you're looking at that sort of advanced structure. Hope that helps. Awesome. Matthew's asked, can a bear trust use have multiple loans, or do you require a separate bear trust? I don't think I've seen two loans under a single bear trust. Colin, you might be able to provide some.
No, you pretty much need to set up a new one every time you're buying. Yeah.
So a separate bear trust or custodian trust, separate trustee. And then, so I'm guessing your scenario, you might be looking at multiple properties, then you would have multiple loans with separate bear trusts. Yeah. Unless there's a bank who's okay with sharing it, but I just think it's so complex that they might not want to touch it.
We looked into something similar very recently, and we couldn't find a lender that was going to let it happen.
Yep. Okay. Cool. Good to know. All right. I think that's all the Q&A coming through. But hey, again, really appreciate your time, Colin. Love the work that you do for our clients, and yeah, on behalf of the people who are listening as well, thank you, and thank you to everyone who's joined this morning. And hope to see you at the next webinar, which is our October federal budget debrief. Let's hold our breath for that one, eh? All right. Thanks, everyone, for joining, and we will see you soon.